Welcome to Upthinking Finance, a podcast that offers a unique and discerning view of economics and financial planning. Here are your hosts, Emerson Fersch and Amy Lenouble.
Author Paulo Coelho once said, "None of us knows what might happen even in the next minute, yet we still go forward because we trust, because we have faith." So I want to welcome today my friend, business partner, and today's co-host, Amy Lenouble. Ames, welcome back.
Thank you.
So one of the cool things about our work is we get a chance to talk to a lot of interesting people, and it's not just all business. Oftentimes we get to talk about life and what people see. And today's guest is interesting because he put together a monthly newsletter for one of the companies we place assets with. And he's probably one of the most successful people I know in taking a lot of information and making it not only thorough, but very concise. And so we get updates on geopolitical events, we get updates on economic events, and we get updates on all the different markets. And so, we had a fun chat with him. When was that? A couple of weeks ago?
Yes.
Yeah. And just started talking about things, and we all kind of were on the same page at feeling that things just feel like they're hitting kind of a breaking point. And so we're looking forward to sharing that discussion with you today. Amy, why don't you tell us a little bit about our guest?
Yeah, definitely. Richard, I just so enjoy talking to him. He's so charismatic and intelligent, but Richard is a portfolio manager at Resolve Asset Management Incorporated with 18 years of investment experience on both the buy and sell side of capital markets. Richard is a CFA charter holder, and he spent the first 5 years of his career as a trader for two of Brazil's largest independent brokerage firms, and then almost 2 years as a portfolio manager for one of Brazil's largest pension plans. In the following 3 years as a partner and co-portfolio manager at a boutique asset manager. So very, very well-rounded. He joined Resolve Asset Management in 2017 and has been registered with the OSC, the Ontario Securities Commission, as portfolio manager since 2018. So 6 years now. And he's a regular participant in Resolve's weekly Riffs podcast series as well.
My pleasure to introduce, coming to us from Toronto, Canada, our friend Richard Laterman. Richard, welcome to Upthinking Finance.
Thanks for having me.
So for the benefit of the listeners, maybe give us an idea of what your kind of typical day is like, the type of people you interact with, and where you're getting your research so people understand, really the exposure you have and, where your ideas come from.
Yeah, for sure. And again, it's a pleasure to be with you guys. We talk, I think, on a quarterly basis to give you updates on our strategies. And I guess the motivation for this conversation was because our conversations tend to exceed quite a bit outside of the strategy realm. And we talk about global macro and some interesting topics. And those tend to be some of my favorite conversations. So I tend to speak to advisors for the most part, but also some institutional investors, family offices, and sometimes high net worth individuals that are just engaging with our content, right? So whether they're investors in our strategies or they're considering our strategies for their portfolios, and I tend to, most of my day, spend time with these people, either giving them updates on the strategy or just kind of walking them through how we think from first principles about, building diversified portfolios, thinking about strategy construction, thinking about, portfolios that are going to be agnostic to the macro regime that we're in, right? It's always a useful thing to remember that we have been in a particular kind of regime for the last 40 odd years, or for a good chunk of the last 40 years, that has favored stocks and bonds and U.S. stocks and bonds. And so all of these are topics of conversation on a daily basis. I'm also responsible for writing a lot of our commentary here. And I sit in our research meetings, and I participate in the research meetings. So part of my job over the last several years has been to take what we're doing on a quant level. And when you say quant, systematic, machine learning, you throw these terms around. It sounds complex. It sounds esoteric. And I try to bring this to more approachable language and also marry it and intertwine it to some degree with what's happening on the global macro stage. So trying to explain to people the importance of having exposure to certain asset classes. Things are happening in commodities and in currencies, and these can offer opportunities for a diversified return stream within a portfolio. And so The writing helps with the sales and the business development side of things, and the podcast as well. So we have a podcast, a couple of podcast series that we run, and I am one of the co-hosts. And the writing and the sales and all those different activities kind of there's a bit of symbiosis there, and they help me be sharper with my ideas and get some pushback when I speak to people that don't quite agree with them, and so it helps me keep me on my toes and to thrive to a little bit better every day.
Cool, yeah. And so I was going to say on these podcasts, because I've listened to a few, you guys interview a lot of different people. I mean, these are not like mainstream names that I've seen.
Yeah, I mean, we've had people in the global macro space, which is an area that's near and dear to my heart. I began my career, I'm from Brazil originally, so I began my career as a portfolio manager and trader for Brazilian equities. But I was always a keen observer of the global macro space, just more of a top-down kind of guy, and that always interests me. So I'm one of the guys that pushes for those types of guests. We obviously have people in the systematic quant space as well, CTA type of guests, people that think similar to how we and have similar investment philosophies. But we also have, guys like Doomberg. I don't know if you've caught any of those episodes, but he is a pseudonymous character. I think he's originally Canadian, lives in the US. He does not show his face. He appears as an avatar, a green chicken avatar. We've interviewed him a few times now, and he writes one of the most popular Substack pages, and it's focused on commodities for the most part, energy transition. He's a controversial character, and he does not shy away from controversy at all. I shouldn't say he's a controversial character. I think he's a very sharp and sound thinker, but I think he's not afraid to go against the grain in the mainstream media. And so because of that, he has sometimes been portrayed as controversial, but I think his ideas are very sound and his arguments are great. But anyway, he is yet another one of those characters that I try to listen to a variety of different podcasts and get ideas for guests, and he's been one of those guys. So yeah, we try to drink from a variety of different sources for podcast ideas and for interesting conversations.
Amen. So pretending we're in one of our quarterly meetings right now, having a conversation, kind of segueing into, so what is your view of the world? Or last time we, discussed things, we were talking about things being kind of at a turning point. And how would you describe that?
Yeah, it's really interesting. Last time we spoke, we had this sort of wide-ranging conversation about the state of things from an economic and global macro standpoint, but also geopolitics, which seems to be more and more consequential right now. It seems like geopolitics hasn't been this consequential since maybe the end of World War II, or maybe at the height of the Cold War and in the Cuban Missile Crisis. But there seem to be, and I do caveat this with the understanding that we are all in our own personal information bubbles. So our perception is largely shaped by the algos that are feeding all this information to us. But I do feel like there is a tangible, there's a shift. We are coming into sort of a scenario shift, a paradigm shift, if you will. And it seems tangible in a lot of the things that we witness on a societal level, all right, whether it's the YOLO mentality or the meme stock craze and sort of this financial nihilism, which is one of the topics that I've encountered in some of the readings and podcasts that I listen to that seem to really strike a chord with the younger generation, but also on the macro level, which is where I kind of spend much of my time. There seems to be an unsustainability to the way the system is currently set up. Too much debt in the system, inflation numbers somewhat adjusted and massaged over time, and you have all these, they call them hedonic adjustments and shifting of the basket of what CPI actually is. But overall, I think there's a feeling, and I know that this is true for me personally, but a lot of the people that I speak to, that our inflation, the experiences that we have of our cost of living is much higher than whatever the 3-4% that CPI would tell you on a rolling 12-month basis, right? Where our basket of consumption would probably, show us having a much higher, perhaps a double-digit kind of cost of living, of rise in our cost of living, and I think that that suggests that there's a lot of people there that are around the world that are suffering from these cost of living. I don't think wages are keeping up with that. And I think this is now also manifest and has been manifesting for almost a decade now. I think it began with Brexit and then the election of Trump, but it has been manifesting in the political stage as well. And we are now seeing European parliamentary elections gearing farther to the right. So populism is on the rise again on the right, but it seems like populism both on the right and on the left have agreed that one of the bipartisan ideas that they have is that spending more is likely to be the way forward for a lot of people, and this probably suggests that we're going to have more indebtedness going forward, and so it kind of feeds this cycle that we seem to be in that would suggest that we're not. The history serves as an analog to what's happening today. We can't go on like this. I mean, we are very good at extend and pretend, right? Kicking the can down the road, and we know that the system is able to morph and shift and to adapt. But there is, at least the way I see it, it's unlikely that we're going to be able to extend and pretend for much longer.
Yeah, I guess the thought that came to my mind, you talked about numbers, and that's the thing. I mean, so the base thing here is, and I think we're in agreement, what we're told doesn't align with what we feel and experience. And I think that's for a lot of people, without necessarily knowing where that leads to, there's a disconnect. Then you add on, I read Zero Hedge every day. And you add, you read these employment numbers that constantly come out, then they get readjusted. Then you find out, okay, well, that's actually illegal aliens getting hired for jobs, and it has nothing to do with, what I mean? And you start seeing how, and so then the challenge is, well, how do you manage, how do you make financial decisions for clients in an environment where you can't even trust the numbers that are coming out, right?
Yeah, and you really have to drill into the data. So to linger on that point about the employment numbers, you see new job created as the headline, and then once you break that down, you see that most of those are part-time jobs, and that full-time employment is actually declining. And you have the household survey telling you one thing, and I forget the name of the other survey, and there's a wide disconnect between the two, and one of them is more empirical, the other one is more a statistical model that is used. So there are all these interesting ways that you can finesse the numbers to serve a narrative purpose, and I think the powers that be are very good at that, and the establishment seems, the system wants to perpetuate itself, and no one wants to go through the pain of the catharsis that would see us reset the system or allow for some kind of debt jubilee or debt refinancing or something that would allow us to sort of clean that slate on some level. So we continue to tell ourselves that the numbers are good and because of this, and we put a positive spin on some of those numbers, and we just keep pushing the ball forward to try and perpetuate this.
Definitely. You're right about that. I remember reading something, I don't remember who said it, but it was like the news used to tell you facts and you would come up with your opinion, and now it tells you an opinion and you have to find the facts, and people just don't have the time or the energy to find the facts, and a lot of the time, or they just don't care or can't care. There's such like an emotional component to it too, and a mental capacity. It's not, that doesn't get discussed a lot. But that is true what you said about narratives, because the truth of the matter is, when you were discussing, what's being said versus experiences, and you had kind of mentioned the younger generation. I don't know if Lord willing, I'm still considered younger generation, but those generations, the truth of my experience and the experience of my friends, and I actually have the least degrees of my friends. I mean, I have like a bachelor's. A lot of my friends are masters and PhDs. These are educated people working full-time, contributing to society, and none of them own a home because they can't, not because they don't want to. I mean, that's unusual. Educated, working, can't buy a home, can't buy a condo. But then you're reading, like you say, there's new jobs and we're flourishing and inflation's going down, but I mean, I just bought a $20 burger at a restaurant by myself, that was $12 last year,
Yeah. And I think the incentive structure that we currently have in on a lot of levels of society are very skewed, and they are, for instance, the idea of narrative and the news now feeding us what we want to hear, or if it bleeds, it leads, and so focusing on the outrage as opposed to providing us with a common narrative. So you now have media sources that feed opposite sides of the aisle, and you're faced with this sort of audience capture to some degree, and that pushes us, to be farther and farther away from a common reality to a shared reality. So I think that is part of the problem, and the incentive structure, not just in media, but also in financial markets and short-term thinking, as opposed to having a long-term plan. It's almost like people realize that, this is unsustainable. Sooner or later the gig is going to be up, so we might as well extract as much as we can from this while this is still going on. And so you see a lot of this when it comes to discussions around compensation or share buybacks, and a lot of the distortions that you see a lot of companies raising debt to buy back their shares. And when it on its face, there's nothing wrong with that. You can shift your capital structure to have more debt, more equity. That's not the problem. The problem is oftentimes you're using that to sterilize the new issuance of large stock compensations, and those issuances are based on short-term metrics that might not necessarily be aligned with the long-term goals of a particular company, but it is really geared towards allowing people to, maximize their short-term gains. And so I think about this a lot. A while back, I came across through I forget which podcast it was, this idea of left and right brain hemispherical differences. There's an interesting book by a gentleman called Ian McGilchrist, Scottish guy, and the book is called The Master and His Emissary. And it talks a little bit about this idea that the master should be the right brain, or the right hemisphere, I should say. And this idea that the hemispheres are completely specialized, and only one of the hemispheres does certain tasks and the other does the other tasks, is not quite right. They're both able to do, whether it's language tasks or math or all these other different domains that we encounter, but they're specialized in certain aspects of it. And the left brain seems to be more reductionist. And his thesis is that we should allow for the right hemisphere to run the show, if you will, or to have the overarching decision making. Send the emissary, the left hemisphere, to be the analyst, the system that breaks it down into its principal components and tries to understand what's going on, but then brings it brings the information and the findings back to the right brain for integration. And his argument is that we keep living in a society, or that our society has been shifting more and more towards left brain thinking, reductionist, gamified, itemized, rewarding sociopathic behavior, and the thesis, it's really interesting, and the book is quite large, so you might want to, and the listeners might want to search for Ian McGilchrist and his appearances on a number of podcasts to familiarize themselves with the topic. But I found it fascinating as a framework to think through what we see today in human behavior and society at large.
Very. I love that. Rewarding sociopaths. behavior, not sociopaths.
And the sociopaths themselves, I think.
It's not funny. That's so sad. Yeah, that's interesting. No, I like the division or the explanation of the two, and how they kind of work together. So, because you got me there. I'm curious. So the sociopath behavior, I'm assuming, means someone who, it's like we focus on work, we focus on the execution, people's feelings or how it affects people doesn't matter. We're goal oriented because that's what matters. Is that am I getting that?
To some degree, as I understand it, it's a lot to do with a narrow focus on goals or in maximizing one's utility without accounting for externalities or downstream effects of one's actions. And I think that's kind of the criticism there, that we whether it's climbing the corporate ladder or climbing the political arena and becoming a political leader in a party or in a country, that sort of behavior seems to be rewarded more and more, encouraged. Yes, the incentives seem to be aligned for that sort of behavior to become the norm and to the winner takes all, winner takes most within that game, within that competitive environment.
For sure. An idolization almost.
It's so interesting because you have these conversations. Like I had an interview with Charles Hugh Smith a few weeks ago, and we got into the part you're talking about, which is it's almost like there's been a separation because the other side of the brain, there's a spiritual, creative element that I don't know, I'm not an expert on this stuff, that's been suppressed. And then Russell Napier, an economist over in Scotland, talks about, if there's one thing you want to look at to really discern where motives are, it's incentive. To determine where somebody's priorities are, it's what are they incentivized by? And, Amy, you're bringing up the generational thing. And I think that's where I see, you see this, the breaking point manifesting when you see, my son is in college and they send out emails probably 3 or 4 times a year to the students and the parents, making sure everybody's aware that they've got these mental health support, depression support, all this stuff available on campus. And, we never had that when I was in college. And the first blush is, well, what's so hard about it? It's just college, right? But what's hard about it is the fact that, you drop down a couple generations from millennials, to like the Gen Z, where these, like you said, Amy, people can't even afford to take care of their medical bills. They're literally scraping, and we live in a low cost of living area in Utah right now. And nobody makes money. And they're struggling. It's like 14% poverty, intergenerational poverty. So it's like continues to get passed on. And what you get is you get a group of people who have no hope, that don't see why. I mean, why would you go to college to get into a system that you just literally don't see offers you anything? And I think that's where all of a sudden now you realize, okay, that's the breaking point, because at what point, I think it was Charles that just said, at what point do people just say, I'm opting out of this, I'm done. I don't want to participate in this anymore. Then where do you go, right?
Yeah, they're living to work instead of working to live. It's like it's just too much.
I think that's exactly right. And you're caught a little bit in this rat race. And I think this despondency, this feeling that you're just not going to be able to make it in the system is, very scary. It should be scary for everyone, because as you get an increasing number of people faced with this situation and within this mindset, they not only cease to be productive members of society, but they become that potential wild card, that potential for whether it's violence or extremism or people just saying, to hell with it. If I can't provide for my family or make a decent living or live a fulfilled life, then I might as well just misbehave in a number of ways and create as much pain or inflict as much pain as I can. And I think you see that partly I think you definitely see that in Europe with what has happened through the immigration crisis and the inability of many European states to integrate these people into their society, so they become second-class citizens. And at least the studies show that this is particularly dangerous when it's young men, unemployment across young men, and they become easier targets for radicalization. And I don't know, I would imagine to some degree this is not just a European phenomenon, but a Western phenomenon, and I'm sure you would have that taking place in the U.S. to some degree, and that might be manifesting through political violence or just the way people are voting and bringing in candidates that are telling them who's to blame for this, right? If you can find a target to point to and say, okay, these are the people that are creating all this pain in your life. When you're in pain, you become an easier target to be lured by this sort of easy narrative or these easy solutions that are by no means easy, but they might seem at the surface.
So here's a question. Okay, getting back to the finance, because you talk to a lot of people, and I know you guys interview the green chicken guy, and you get a lot of different opinions, which I think is critical now. I just, to me, it's like the more information you get, the more you can, like Amy said, about gathering your own facts to kind of formulate your own view of things that resonates based on your own experiences and everything else. But in our industry, and I'll say, and I don't know if this is a fair question, I don't mean to put you on the spot. My sense is that there is an element of, and I'm talking about it like our, advisor level, maybe even portfolio manager level, the kind of the more main, that there is an element of perpetuating the system. And I'm just wondering, and I'm not trying to make it sound like we're so smart and everything, but I do feel like at times we're on a bit of an island. What do you see? Is that a fair question? I mean, do you feel like that there are people that are really opening up to the idea? And maybe this isn't a good question because your firm is already dealing with in a different type of space as it is. You guys aren't mainstream, so maybe your exposure. But I'm sure you talk to people and reach out and get firms that just aren't open to anything that's outside of 60/40, right? So I'm kind of curious, maybe if that makes sense. That's one of my long questions I'm trying to avoid. Sorry.
No, it makes sense. Yeah, I think to your point, there's definitely a selection bias. I mean, the people, I don't do cold reach outs to any groups because we produce so much content here at Resolve. We end up having a lot of inbounds or people that are downloading our content, and then we send them an email and say, hey, do you want to chat? I saw that you were reading up on our portfolio construction methodology or this strategy or that strategy. And so there ends up being a selection bias that we end up speaking to people with whom our message already resonates to some degree. And so again, it goes back to the bubble, to the information bubble. So most of my conversations end up being with people that to some extent understand that they need something beyond 60/40 and that they want to expand that portfolio canvas into alternative strategies and want to understand a little bit more, what kind of diversification we can bring to the table. And oftentimes the drive to embracing alternative strategies and to thinking outside of the 60-40 sandbox has to do with the perception that on a macroeconomic level, things are heading for an unsustainable situation. And a lot of this, I think, has to do with, to some degree, how long this bull market in equities has been, which is pretty powerful, but also what happened in 2022, which was a major wake-up call to a lot of investors. And since then, we've had a bear market in bonds, and bonds have been a particularly difficult place to be in. But yeah, I do think that there are still a number of investors, maybe it's the majority, I don't know, but that are very comfortable with 60-40. And I think that's within the advisory space, that's true, partly or maybe mostly because clients are comfortable with 60-40, because we are all dealing with recency bias. We're all subject to recency bias, and the people forget that we had a lost decade between 2000 and 2009 for equities, but the period between 2009 and 2021 was very powerful. The period between 1982 and 2000 was also a very strong performing period for U.S. equities. And so you take those together, you have a 40-odd year period where you do have a blip in the middle, but for the majority of the time, we spent with 60-40 upwards and to the right, with negative correlation between stocks and bonds. So there was that offsetting mechanism between the two. And you see the technology evolving over time, and you have these first trillion-dollar market cap companies, and they're all in the technology space. And so this is what drives, I think, the zeitgeist and the retail investor cohort at large to want to own stocks and to see that as a be-all, end-all, perhaps not realizing what the valuations, what the price implies on the valuations, and how much of a Goldilocks scenario, or how much positive news is already priced into stocks at a certain level, and how difficult it would be for that to be sustainable. People don't really go through that calculus. They look at these companies that they're familiar with, whether it's Microsoft or Google or Apple, and they know these products, and you have this illusion of control. It's like, oh yeah, I consume this product. I know people that consume this product. This is something that I want to have in my portfolio because I believe in this company. It's a naive way of thinking, but I know a lot of people that think of their portfolios in those terms. And then for the advisor, it becomes sort of the lean into the gradient, right? Walking downhill, the easy solution. And advisors are part-time therapists, as I'm sure you guys are all too painfully aware. You want to keep your clients happy. And if your client wants to stick with this portfolio construction, some of them might be amenable to you telling them that you might want to consider having a portion of your portfolio that's dedicated to diversification. But I'm sure there's going to be a lot of advisors that just don't want to deal with the hassle, and will just go on with whatever has been or seemingly has been working for clients, and not have to go through the education side of it, or the pain, or the tracking error pain, which is something that we talk about a lot, of being different from that 60-40 construct.
That's so, you just said a mouthful.
I went along there, didn't I?
I don't even know. I want to comment on 16 things, but that's true. When you had mentioned the 60-40 and the client comfortability, and I was thinking, and advisors too, and then you nailed it. And you're right. There's wanting to make a client comfortable, or maybe even idolizing your own comfort of, I just don't want to argue. I'm making up numbers. I have 100 households I service, 200 households. I just don't want to have uncomfortable conversations all day. And you think about, like, well, how do I appease without going too far? How do I not even value? How do I satisfy the feeling, but also satisfy like the desire for this rate of return? And how do I give them this perfect product, but also give them the hope and confidence? The answer is you don't. You don't. There's no, I'm not God. There is no way to just satisfy everything. And the discomfort, I think, leads to better things, better relationships, more real relationships. We talk all the time, we being Emerson and I, discuss all the time about structural diversification and how we put multiple things in a portfolio that with the potential to benefit regardless of market volatility and fluctuation. You don't put all your eggs in one basket, God forbid you have a 2022 and then, 23. You want to diversify. And Emerson's always good at saying, when you diversify, you're always apologizing for something. But the truth is, Emerson and I, very recently, because we've only been partners, the last year and a half, even just closer to a year and 1 month, have decided that we're going to be uncomfortable and we're just going to do what we feel is right and best, despite comfort and despite awkward conversations, despite misunderstandings. We're willing to have this discussion with the 200 households because we genuinely feel it's the right thing to do and the best thing to do. And we made that agreement. We're in alignment. And I have to say, very surprisingly, that it has been fruitful and that people are open to it, in my experience, if you, bring it up. And of course, they have an established relationship.
Amy, you're right. And the thing is it gets back to where we started this conversation, because people, everybody's at different levels of, we'll call it awakeness if you want. I don't want to say woke because that goes a different direction. But, as to the why they're feeling, but everybody's feeling some sense of disconnect. And so what we're willing to do is get in there and say, well, this is how, from the financial end of things, how we feel we need to address this. Because we're even the most, and there's very few clients that we work with that are just want to continue to trudge the road of happy destiny that we've experienced the last 40 years, right? Most feel that for all the reasons, the inflation says this, but I know it's costing me this. I mean, all that. And so anyway, Amy, you said that you really expressed that well, and I appreciate that because, and then as an advisor, I mean, I had this conversation with Rodrigo a year ago when he was on, and we talked about, S&P's going one direction, these, other strategies, commodities, as an example, had a dead decade, right? Well, who wants to have to explain that? Well, that's kind of the job, right? I mean, isn't it our job to get, like you said, Amy, get uncomfortable and explain and walk people through a longer road versus what's just been happening? I mean, anyway, I could go on and preach. So you're our guest. Why don't you speak to that? Or maybe you already have.
What you guys have said resonates a lot. I mean, we have a phrase here that we need to get comfortable with being uncomfortable. And we wrote a piece about this a while back, which has to do with, portfolios that are either going to be holding on to that previous paradigm, 60, 40, 80, 20, whatever it is, stocks and bonds, and not being resilient to the types of shocks that we saw in 2022 and the types of shocks that seem increasingly likely given what we've discussed, that the macro and geopolitical backdrop and the potential for inflation volatility, which is really what the 1970s were all about. People think it was high average inflation, but it was really wild swings and high costs of energy, and where energy goes, so inflation goes. So getting comfortable with being uncomfortable means you're either going to embrace that your portfolio is not going to be resilient to those shocks if you stick with what was working in the previous paradigm, or if you're going to embrace diversification and really think about portfolio construction from a first principles, that you are going to be uncomfortable, at least in the very beginning, with some tracking error and being different from your neighbors and your friends and your peers, and having something that's going to be, moving in a different direction at times. And we also have a saying here that is, the best portfolio for any client is the one that they can stick with. And so a lot of people, because what happens is you can bring all this diversification to the table to your clients, and if you're discretionary and you're a PM and you're able to make these changes for them yourself, and you don't really need buy-in from them, that might work for a while. Eventually, that portfolio is going to go through a drawdown, or certain portions of the portfolio are going to go through a drawdown. If it's really well diversified and you're rebalancing the pieces properly, maybe you're going to minimize that drawdown and smoothen out that path. But at one point, you're going to have a conversation with them about what's going on. And if you did the work up front and you had those uncomfortable conversations with clients and you explained to them the benefits of holding many of these positions, and you explain to them the mechanics, and some clients are more amenable to those conversations and more open to the learning curve, and some people are just like, you're my fiduciary, I trust you, you do your thing. But it's important to the extent that you can get them in the conversation and somewhat on board, to get them on the buy-in, because then they will be able to stick with in the inevitable moments of pain that any strategy or any portfolio is going to endure. So I think that's why I say you guys, any advisor out there is a part-time therapist, because and sometimes more than just part-time, because you really do need to be able to handhold, and I think that's where we all earn our salaries and our fees, right? It's doing that work for our clients and having those uncomfortable conversations and doing the education, which is, again, why we're so big on the content side of things, because it helps us sharpen our thinking and what we're trying to explain and why we do things the way that we do. And it also allows us to help advisors have better conversations with their clients about why they would want to include some of our strategies in their portfolios. And it's very good to have these conversations live with you guys, because you get sometimes pushback, and you get these questions, and you improve your own understanding of what you're doing and why you're doing it, and of the specifics of your strategy when you engage in that exercise on a pretty regular basis. And I think that's very helpful.
I like that. The one you can stick with, the longevity.
Because they're going to sell at the worst time, right? If they have something that they don't understand, they're going to probably sell it in a drawdown when they should be, in fact, waiting to add to that position.
Yeah, it's happened. It's happened many times. Yeah,
many times, I'm sure, for a lot of us, and for us as well. And we're, I don't know how many asset management firms out there can claim that they do this, but we are oftentimes telling our clients, if you have a position in one of our funds and it's, say you landed on 10% for your portfolio for this product, and then all of a sudden we are up, your traditional betas are down, and we've gone from 10% to maybe 12 or 13 or 15% of your portfolio passively, just because of the drift in markets and the offset that we have provided to your portfolio. You should probably sell us down. Bring us back down to that original 10% that you intended, and use that cash, those proceeds, to buy some of the other strategies that you still like in your portfolio but have gone down. And then the flip side of that is you should also consider adding to our strategies when we are in a drawdown and selling out a little bit of the excess positioning that markets will shift some of those other funds into. So something you own that's 25% went to 30, sell that back down, and so on and so forth. So you can harvest a rebalancing premium from that. And you can also, you'll eventually, on a money-weighted basis, beat our own equity line in our own products if you're adding to us in a drawdown and selling out when we are, peaking, if you will, in a cyclical peak. So that's something that we discussed quite a bit, and it helps, I think, build trust with our investors, that we are oftentimes recommending to them that they should not only buy our strategies, but also think of us within a strategic portfolio construction and trimming us back down to the original weight they afforded us when we do outperform some of the other components.
I appreciate these conversations because it just reaffirms where we've kind of arrived just through our own process of just thinking and really discerning and as Amy said, really just trying to do what's right. And I appreciate about your company in particular that you guys are out there with your information and you're not afraid to talk to anybody and make time. I mean, I've had Rodrigo on, I had Mike on, and I just appreciate it because I think this is a shift that, again, from our side of the desk, a lot of people in our industry just aren't willing to go to. In fact, I'll just share real quick. Somebody that works for the firm we're licensed with mentioned a roundtable he's supervises, and he said that the advisors are still going back to the old DCA over 6 months and this, the same old stuff, trying to deal with the client's concerns, right? That they see things, they're feeling the same way like we've been talking about. Yet the advisors don't know how to advise them, and in fact, he even made the comment that some of the advisors are feeling like they should sell their own portfolios because of the concerns of their client. I mean, talk about a complete, like the role reversal. Right, and it shouldn't be that way. So the last thing I guess I wanted to ask you, and I know we're just about up against it, and then Amy can close this out, but I just wanted to ask you, if you had to kind of guess, because I'm with you, I think there has to be some pain. I've had this conversation with a few people that there's a shift. Any idea, and again, I'm not asking you to predict, but I'm always curious. People like to know what, somebody in your situation sees where the final hole in the dam is that really starts to accelerate a change. Or are we just in the midst of it and it's just this gradual thing that we're not really able to discern on a day-to-day, but you look over 6 months and a year kind of a thing?
We wonder if people that were living through the early 20th century would have been obvious to some people that they were walking into a World War, and then in the 1930s again, would people? I mean, there are always signs on a macro level, and particularly as it pertains to the U.S. I think the decision to weaponize the U.S. dollar to some degree with the sanctions on Russia, whatever value you may ascribe, and obviously that war is horrific, but the seizing of assets without due process and the capture of treasuries and the savings of the assets of central banks, and not going through the rule of law and through the normal legal channels to impose sanctions. That sort of thing, I think, has, if you're a fiduciary in a foreign country that could be an adversary to the US, if you're a central banker in any number of countries, that was a wake-up call. Without a doubt, these people are now considering alternatives, and a lot of the run-up that we saw in gold recently has apparently been China buying up gold because they are trying to maybe create a little bit of ballast for the system that they're trying to offer as an alternative within that BRICS construct. And so there's that old Ernest Hemingway phrase, how did you go broke? Well, gradually and then suddenly, and that's oftentimes how change happens, right? It's gradual. And this isn't to say that, we're going to wake up tomorrow or in a year or in 5 years, even 10 years, and that, the US dollar is going to have completely lost its hegemonic status. I don't think that's exactly how that's going to take place. I think that the appetite at the margin to save in dollars is perhaps dwindling, or it seems to be dwindling, at least from some corners of the globe. We still have so many trillions of dollars of outstanding debt that needs to be serviced that are issued in US dollar. And the work of Michael Howell of Cross Border Capital, I would just point out, we had him on the podcast, and he kind of taught us a lot about how that works and the recycling of that debt. So it's hard to imagine that the US dollar is going to go anywhere anytime soon. But at the margins, again, you start to see an appetite to save in hard assets or in assets that can't easily be seized by a potential geopolitical adversary. So that's one of the signs that it seems to have shifted in the last couple of years. Obviously, as the heat in the geopolitical stage increases and there's potential for escalation in what's happening in the Russian-Ukraine conflict, what's happening in the Middle East, potentially something in the Taiwan Straits, were something like that to escalate, were we to find ourselves in a hot war against Russia or China, that would definitely complicate things a lot further, and we would see an acceleration of the end of the Pax Americana, right? That this unipolar moment that we've lived since 1945, or maybe since the end of the Soviet Union. But yeah, those are some of the things that I'm looking at that seem to be signs of a scenario shift, signs of a changing in the world order, if you will, to a more fragmented globe and less of the global village that I think a lot of us have grown accustomed to in the last few decades with globalization. I don't think that's going to be completely undone, but at the margin, we seem to be we seem to be creating more silos and less integration, less cooperation, a little bit more competition. And those tend to be, complicating factors, I think, for the coming years.
That's so good. I really like that quote, gradual, then suddenly. That's so accurate. But thank you. Yeah. Thank you, Richard. You're so knowledgeable and thorough, and we just so appreciate this candid and uncomfortable conversation of real things, of real things going on in the real world, real experiences. Thank you for just being real. And it's been an honor, and thank you for joining us on Upthinking Finance.
Thank you for the kind words. The honor's all mine, and look forward to seeing you guys in our next quarterly chat, and maybe I'll come back on the pod in the next little while. I've really enjoyed this conversation, and you guys are great. Keep doing the great work you guys are doing, and if there's anything that we can help, let us know. Thank you.
Emerson Fersch and Amy Lenoble are registered representatives, and securities and advisory services are offered through LPL Financial, a registered investment advisor, member FINRA SIPC. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. The guest speakers and the companies they represent are not affiliated with or endorsed by LPL Financial or Capital Investment Advisors, LLC. Individual tax and legal matters should be discussed with your tax or legal expert. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risk, including possible loss of principal.